All right, welcome everyone. Episode number 28 of the Wide Lens podcast. I've got Matt Rigby here with me. We are covering the latest topics in financial markets and recording this on Friday the 19th of August 2022. A much warmer Friday
well, the
morning.
sun's out. I don't know if it's warm, man.
Sun's out. It's warmer. It's not pissing down with rain. I think winter's over. The bear market's over. Springtime's
Happy
here.
days. Bring
Spring
it
bull
on.
market. Let's get into Matt's market minute.
Boom. All right. The ASX over the last 5 days up about 0.5%. Now down 6.5% year to date. Man, we're getting there. We'll get there. So reporting season, bunch of companies coming out this week. Some of the key or notable companies, the following beat expectations. Santos, although they were down 1.8%, didn't beat by as much as what people were hoping, which I guess means they missed. But anyway, their profit went from 354 million to 1.16 billion. So nice little increase there. BHP up about 5.25%. Super Retail Group down about 4%. Babcock down about 0.3%. Brambles up about 11.5%. All the shipping and stuff going on around the world certainly helps. And Treasury Wine up just under 6%, bouncing back pretty strongly from, was it a year or two ago that China kind of canned all their imports? Anyway, bouncing back, finding new markets, doing well. Seek down just under 6%. They came out with good numbers, but their guidance fell about 10% short of where the market was expecting. Car sales up 1.3%, no surprise, new car sales. So you go to difficult to find, so you go to use. So that's where they're making money. Amcor up about 4.5%, and Aurora, the packaging business, up about 3%. Following companies missed, down at EDI, down about 4%. Corporate travel up about 0.5%. Magellan just can't take a trick, down 7.5%. CSL up 2.5%, positive guidance and good commentary around their blood collection business. That's been a cause of concern for a while. Origin down about 3%. Transurban.
Do you know why they're down? Origin.
Why?
I cancelled my utilities with them.
Oh. Your exorbitant gas bill every quarter.
That's gone off their revenue.
Yeah.
They're like, shit, this guy's gone. Our revenue's
Markets found out, like, man, where are they going? Let's bid up with that stock.
AGL, look out.
Look out. Transurban, weak outlook, which is interesting. I think they cited higher interest costs as a big issue there. So no big surprise. Medibank Private up about 2.9%, and Blackmore's down about 4.5%. Couple of points of note. Xero, they were down about 4%. They had their AGM and came out with comments that they had subpar growth in the UK. So it was weaker than expected due to a less than buoyant macro environment.
What does that mean?
Well, I think it means the UK is in the shit and they're heading headfirst into recession and so it's not looking good.
People are not going to use their accounting software?
Yeah, it's funny, isn't it?
I mean, you don't have to do your taxes in recession?
Do you... Yeah, I mean, I don't know. Do accounting firms start looking for cheaper alternatives? I mean, they're not cheap.
It's not an expensive product, I don't think.
They're not the cheapest, though, I don't think.
I don't know what in the market.
Look, any accountants out there that use Xero, got any thoughts on that? Love to get your insights. But anyway, the UK they're up the creek. Nearmap up about 34%, attracting a bid from Thoma Bravo at 210. I think they were trading at around $1.70 pre the bid. Pretty opportunistic by the looks of things. Nearmap have gone through a number of issues over the last couple of years. They came out with earnings also, delivered a 29% surge in revenue and good outlook for the next 12 months. And James Garish from Market Matters commented that the shorts had their faces ripped off after this. I think the stock was about 8% short, or 8% of the stock was short, and they lost out on that one. So, look, never a bad thing to see those guys feel a bit of pain. And Dexus up about 0.5%. The reason I put this in, so their guidance implied about a 5% decline due to high interest rates and asset sales. So, struggling a little bit under the current market environment. Their occupancy was fairly steady though, which I thought was interesting. So incentives have stabilized, and occupancy, as I said, was fairly steady, about 95.6%. So not too bad, but just a slight insight into the office market, what's going on there. The Nasdaq over the last week, up about 1%, down 18, smidgen over 18 year to date. 41 stocks down more than 20% year to date, 24 in positive territory. S&P 500 up just under 1.5 for the week, down a bit over 10.5 for the year. 160 companies positive, 130 down more than 20% for the year. So those numbers are improving. Fewer earnings, only 643 over the last week in the US. Home Depot came out with some pretty interesting results. They beat, I think they said that the sales, actually I've got it written down here. So beat expectations that consumer transactions fell for the 5th straight quarter. So consumers are transacting less often, but they're spending more because of inflation. And the other thing, I guess, is something to watch is lumber costs, which we saw a couple of weeks ago. We showed that they were down some 40% since the high, maybe even more. It'd be interesting to see how much of that decline gets passed on by, and you could apply that to Bunnings here as well. So I imagine they'll capture a little bit in the margin there. WWE, the wrestling business, down 2%. Thought you might enjoy that. The Southeast Asian online everything company, down about 21%, even though they beat outlook not great. Walmart up about 7%. They beat expectations, but those expectations were lowered pretty significantly about a month ago. Lowe's, like Home Depot, beat up about 6.5%. TJ Maxx, which we've talked about, up about 5.5%. Tencent up 2.75%. Cisco up around 7%. Target missed their lower expectations. So if you recall, they lowered around the same time Walmart did. Clearly, Walmart did a better job of managing expectations. So Target missed. They're up about 1%. And Krispy Kreme, man, if only these guys make gluten-free donuts, I'd be a happy man. But they're down about 14% after.
Do people still buy Krispy Kreme donuts?
Yeah.
Like, where do they sell them? In 7-Eleven, isn't it?
Yeah.
7-Eleven's going through a bit of a revamp, aren't they? With their Johnny's Deli sandwiches now. They're just kind of a bit, doesn't feel as
7-Eleven-y.
Yuck when you go in.
Yeah.
Do you know what I mean?
Cleaner.
It's a bit,
It's brighter.
The floor's not sticky. And
Yeah. Yep.
Good on you, 7-Eleven.
Good job. So Walmart, just further on to that, they had $153 billion in sales for the quarter. So what's that? $600 billion annual rate. And they noted that they were seeing customers from a higher income bracket come into the store and spend. I'm not sure how they track that, but they managed to. And they also noted that consumers were trading down. So going from like higher end deli meats to hot dogs and canned tuna.
Yep.
Which I don't think is all that surprising, but so the sales are still there, but it's the mix, and therefore I would imagine the profit margin in that mix is coming under a bit of pressure.
Yeah, we're seeing that, and you might talk about this later on with some of the stats out of the US. So consumers are still spending, but they're not spending. I think we talked about this a couple of weeks ago. They're not spending money on the latest Jordan shoes they're buying. They're still spending, but less on discretionary. But also with the likes of Woolies and so forth, it's people aren't buying the premium brands anymore, right? So it's the staples, the home brand, value brands, and so forth. So it doesn't surprise, but I guess the hard thing is trying to work out when consumers do that. But it appears though that's what's already happening.
Well and truly happening, absolutely. And the other one, our favourite, Peloton, up, surprisingly, about just under 5%, announcing they're cutting 800 jobs, raising prices. Interestingly, they're burning, and they report next week, but they're burning about $600 million in cash every quarter.
Wow.
At the last reporting date, they had $800 million in the bank, so not a lot of wriggle room there. Not in great shape. The last capital raise was at $41, now sitting at around $17.
With the last raise was $41. It's $12.
Okay, so it's falling even further.
The stock's at $12.
So $12, So this was a couple of days ago I wrote this. Yeah, so $41 was the last raise at $12. So you would expect that they will have another capital raise at some point. It'll be pretty deeply discounted, you would imagine. They're just burning cash.
I saw they're bringing out their bike with a bit of a DIY. So I don't know how it works now, but I think you assemble it
yourself.
Yeah, well, I believe they're
Okay.
like a cheaper alternative. I don't know how it works. I thought that's how you set them up already. I don't know, but I did read something that they're looking at bringing sort of a product that's cheaper out to the market as well.
Well, it's interesting because their inventory has gone. Don't quote me, but last year, let's say, it's something like tripled or quadrupled in terms of stock they've just got sitting in warehouses. So and they're raising prices.
But a lot of retailers in the US are having. If you have a look at what their inventories are, you saw a massive dip during COVID, and then slowly it was climbing back, and that's why we had issues around can't get this. Yep. But now it's back up to pre-pandemic levels.
Yeah, so we saw that with Walmart and Target.
Yep.
Inventory's just gone through the roof, and now they've got a discount. It's just this terrible cycle. All right.
But also one of the other things on earnings, companies are coming out now talking about how they're before they were previously passing on a lot of these inflationary costs.
Yep.
But that's starting to eat into them now. They can't keep pushing that out, and their margins are starting to get squeezed now, which would be really interesting to see what happens over the second half of the year. I reckon the companies have done what they can do in terms of passing that on to consumers.
Yep.
Whether they're able to continue to do that, it doesn't look like they can. But maybe they might get away, and inflation does come down in the second half of the year, and maybe that offsets that. I don't know. I think that it'll be really interesting to see what happens in the second half.
It'll be interesting to see whether they pull the employment lever as well. Whether they start to lightening off the employment cost, because that's a huge expense for most companies. All right, emerging markets up 2.5% the last 5 days, down 12% year to date. Similar to the S&P, that was quite a bit different there for a while. Oil down 1% for the week, up 20% year to date, sitting at $90 a barrel US, and Bitcoin down just under 5% for the week, down 51% for the year, $23,365 a coin. That's US dollars. Just other couple economic bits to just note. The Aussie unemployment number came out yesterday at 3.4%, which is pretty low, which probably all but locks in a 50-point rate rise next month by the RBA, if anyone was in any doubt as to that's what they were going to do. So the rate's now sitting at 1.85, so you could probably expect that to sit at 2.35. New Zealand Reserve Bank lifted their rates to 3%. Their property market has started to roll over a little, so it'll be interesting to see what happens there. UK inflation above 10% for the first time in 40 years, and European inflation, which I thought I'd written in here, I think that came in at 8.9% last night versus 8.6% the previous month of June. And I'll just bring up this chart really quickly from Statista showing energy prices in Europe, and they just keep climbing. So this is annual change as a percent. So electricity is up 30%, energy 41%, liquid gas, so all sorts of trouble there. And
since 2021, it's been climbing.
Even
the beginning of 2021.
Yeah.
Oh, sure. Yeah.
COVID.
Does gas look like it's turned? Is that peaked?
I don't know. They're about to head into winter. I don't know. Just you wouldn't want to be just scraping by at the moment. I think in Europe. And, I still think inflation's got a fair bit to run there based on the back of this, what's going on, Russia, Ukraine, all of that. So, Europe kind of bearing the brunt.
Just on your comment before about, we talking
about? Talking bollocks.
The Reserve Bank of New Zealand and their property market turning. Just something that I've picked up over the last couple of weeks, auction clearance rates in Melbourne seem to have turned or seem to have bottomed out. So we've got, this weekend just gone, weekending 13th of August, clearance rates was 59% in Melbourne. It was 56% this time last year. So 59%. auction clearance rates. The week before was 56%.
Yep.
The week before that was 53%,
Right.
51%.
Okay.
So we've gone 51, 53, 56, 59. So starting to climb now. And we get, so who knows whether that might be a spring phenomenon and whether people are bringing product to the market now because they feel more comfortable with it. I don't know, but certainly...
Well, even if that's the case, you've got to have the buyers there to clear it, right? So if there's more product comes on the market...
Well, maybe the
be
clearance rate's going up because prices are coming down.
Yeah,
And
possibly.
people are happy to accept or happy to buy at these levels, and maybe vendors' expectations are coming down. So I thought that was worth noting. It'll be interesting to see how we go coming into spring. Last year, talking to agents and whatnot, the classic "don't sell your house in winter" wasn't really a thing anymore because no one could go anywhere, and so no one was traveling and so forth. Yep. Normally people are away, it's school holidays and it's winter, and so all of those reasons in 2020, 2021 or 2021 were largely non-existent and wasn't relevant. So I wonder whether, a lot of people, a few people I know in Europe at the moment, a lot of Aussies over in Europe, and I just wonder whether there's a lot of people away. Who knows? Something to watch, I reckon, over the coming weeks.
I think it's a good point, though. I think you're right. I think a lot of people are away in the middle of winter, somewhere warmer, and potentially they come back and buyers come back into the market. Yeah.
So the first thing I wanted to cover was investors are no longer apocalyptically bearish. So I'll bring this headline up from Bloomberg now. Investors no longer apocalyptically bearish. B of A survey shows, Bank of America, global growth, profit expectations rise from all-time lows, and bank strategists still patient bears, eye profit taking. I'll read this quote. This is from the article. Investors are pulling back from their record pessimism about stocks amid speculation that inflation has peaked. Didn't we call inflation peaking in July or August? Just not to brag.
I don't know. We'll have to go back and listen to it. Sure, someone's going, you guys are idiots. You didn't.
Marking a break in the apocalyptically bearish sentiment that had been gripping markets, Bank of America Corp's monthly fund manager survey showed. So currently sentiment remains quite bearish, but they go on to say no longer apocalyptic bearish as hopes rise that inflation and rate shocks end in coming quarters. So I'll bring this chart up here, and that's from B of A Global Research, and it's showing global growth pessimism easing from all-time highs. And there's two lines there. There's the light blue line, which is the net percentage expecting a stronger economy, and the dark blue line, which is overweight equities. And so have a look before we peak out, before those two lines drop. What that's saying is in mid 2021, investors were overweight equities and people were expecting a much stronger economy. Yep. Have a look what happened at 2022. You and I have been talking quite a bit about how investors are so pessimistic about the market, yet their allocation to equities hadn't changed. It's interesting to see the overweight allocation here being so low. In fact, people were more pessimistic and underweight equities than the. This is actually worse than GFC. Net expecting a stronger economy and worse than the global pandemic, which to me is just fascinating. Like why? I mean, obviously, it's the narrative around interest rates that everyone's so fearful about, and the level of debt and the impact that's going to have on households and the domino effect, etc. But that appears as though that has turned.
Yeah, I know. I suspect it's worse than the pandemic because that market decline happened so quickly. Like it was starting over.
Sure,
I wonder if that's it. But worse than GFC is a little baffling.
Yeah,
given what was
it is baffling.
Back then.
So there's some bottom. It appears as though some sort of bottom has been marked there. It's probably too early to tell, obviously, and no one knows what the future holds. But for now, we're not. The bleeding looks like it's stopped. I'll bring this second chart up now as well, which is the B of A fund manager survey. Now, this is showing the average levels of cash, fund managers, average levels of cash. Now, have a look at where we are now. This is July 2022. You're sitting at levels that are beyond that of the global pandemic in 2020, higher than that of the global financial crisis of 2008. And the only other time that you can find cash levels at this point, you have to go back to 2001.
.com.
The dot-com bubble,
bust,
yeah, correct.
And September 11 and that whole period, that's
which we've talked about.
Yeah,
and why I'm bringing these up is because you and I have talked about this. So since then, the market appears to have bottomed out for now in June 14, I think, this year.
Yep.
But since then, and I wrote this in the Wide Lens blog earlier this week, the stock market US stock market, as represented by the S&P 500, has rallied pretty hard. S&P 500's rallied 14.15% since the bottom. I think it's probably a bit more than that now.
More, yeah.
I think it's closer to 17, 18%. The NASDAQ is actually technically in a bull market.
Yep.
Up about 23%.
Killing it.
And the Aussie stock market up about 6% from its bottom. Mm-hmm. What do you make out of all this? What's your take on it?
I mean, there's a few things, but the emotion, whether you're a professional investor or a retail investor, still rules so much of what you do. As much as you try and block it out and whatever it happens to be. I mean, just look at that first chart, the overweight equities and net expecting a stronger economy. I mean, it's all over the place. It's up and down, and that's fine. But to let that then rule the way that you invest, as we've talked about so many times, you're going to miss some pretty good returns on particular days. And then fund managers, I just kind of keep thinking back to 2020 and what was happening back then, and fund managers going to cash, and then others going. I recall there being a real divergence between those that just went cash and held cash, and those that just went all in, just hoping or trusting the process or whatever it is, and the returns, were reflective of that. And I wonder, we'll know in 6-12 months' time whether fund managers are right to hold cash or whether they were not. But I would, just guess that on average, you're better off still being invested the whole time.
Yeah, that second chart to me, I'm just trying to look at some dates here. So July 22 was a peak cash holding. Market bottomed in June, 1 month prior. April 20 was the maximum cash allocation. The market bottomed out in March, 1 month
seriously?
prior. Yeah.
Wow. Okay.
March the 23rd so it peaked on February 19, 2020, bottomed out on March 23. So March 1. So it's a month later. I couldn't find the October one, but the December 08 one, the market bottomed out in March of the following year. March 9, 2009 was the bottom. And I don't have the exact dates for the other one, but I feel like it's almost like this contrarian indicator.
I was seeing that.
Whereby fund managers just go to cash.
Yep.
Because of the apocalypse that's coming, and just the sheer amount of fear in the market.
Yeah.
And it literally, like, you capitulate and you allocate. And 8 or 6, 7% doesn't sound like a lot of money, but when you're managing billions of dollars, it's a lot of money, like quantum wise.
Yeah. And when you're also, I mean, for managers, fund managers, active fund managers, a 0.5% or a 1% difference in return is a big number.
Oh, yeah. It's either make or break
the returns relative to benchmark, bonuses,
Yeah,
so,
sure.
So it can have a fairly big influence or impact on the outcome, and obviously for investors as well.
So I think the bottom line there is, like, you're really, to your point, I think you really need to have a game plan in place and have a strategy and not be thrown around by whatever is going on outside.
Yeah, I was chatting to a client recently saying, we're not looking for the next 6 months or 12 months. We're looking 10 years down the road. Will the markets be up from 10 years from now? History says at every single point in time, the answer is yes. So invest for the long term. Don't look short term, invest for long term.
Yeah. Let's jump on to the next one. I'll hand it over to you.
So I've gone economic again. Apologies for those that aren't all that interested in the economic numbers. But anyway, some interesting stuff came out over the last week. Now, we've talked a little bit about US consumers and consumer confidence and how spending and confidence were at opposite ends of the scale. So I'll bring this chart up now. It's retail sales, consumer retail sales in the US. So the value of purchases were near flat for the period, which is the 1 month period of July. Although when you exclude petrol and autos, it was actually up 0.7, which is a pretty healthy rise. So you can see there on the right-hand side, you can sort of see the trend that's going on there, that the absolute month-on-month return or difference, I should say.
What happened in December 2021?
Yeah, I don't know. It's a good question. This has fallen off the face of the earth. Was that the Omicron wave?
Yeah. Look, you keep chatting.
Yeah. So anyway, so the value of overall retail sales, excluding gas and autos, is probably the one that most people are looking at because petrol is so volatile and autos has been a huge backlog for quite a period of time. So the expectation was for a 0.1% increase excluding both of those categories. So 0.7 is relatively quite strong. And that's keeping in line with what we've seen in consumers spending more relative to their confidence. So sales at petrol stations fell about 1.8% in July. So that obviously reflects a fall in gas price or petrol price, which has gone from above $5 to below $4 on average across the US. So it's fairly major.
And we've seen that in Australia as well.
And we've seen it in Australia.
Diesel's come down too.
Has it? Low 150 for unleaded.
Yeah.
What is it for diesel? You under $2 yet?
Yeah.
Right.
Just depending on which petrol station, but yeah, you can find under $2.
Mate, a lot cheaper to charge up your battery.
Oh, yeah.
For sure. And purchases for motor vehicles and parts dealers fell 1.6%. Now, that I thought was interesting because was it last week or the week before I was talking about the components of the inflation and new and used vehicles were up, and it was still driving that headline number. So that's starting to come off by the looks of things, which, maybe that's an indicator that inflation the headline number will keep dropping as we progress through the back half of the year. So grocery stores, sales were up about 0.2, most likely reflecting inflation rather than people increasing their expenditure there. But for the year, grocery costs are up 13%. That's a pretty big drag on spending elsewhere in the economy. This is probably boring for most people, but I found it interesting. So there's something called a control group that they base part of the GDP number off this control group. So the control group excludes food services, autos, building materials, and petrol stations. So kind of really volatile, almost commodity type businesses. And that was up a stronger than forecast 0.8. So maybe Q3 GDP might actually be positive in the US. So
we'll be out of the recession.
So we'll be out of the recession.
Great.
Already. So that was quick, wasn't it? We're out. And as I mentioned earlier, there's also a lot of indication that is people are trading down in terms of quality. So going from, I don't know, house, expensive wine, Penfolds down to house, whatever it is. So one other thing, or a couple other things. So that's the US. So the US consumer in pretty good shape.
Just can I just add something there? Disney was reporting. It wasn't a question, sorry.
Rhetorical.
Disney came in and said, even though they've got slightly less people coming to their parks, the average spend per person is much higher.
It's much higher. Yeah, like not just 1 or 2% higher, but it's 15% higher.
It's much higher. So even though they're getting less people, the spending's still happening.
Yeah, and the fewer people wasn't dramatically. Like it was only, say marginal.
No, I think it was
but the expenditure was.
And I think the naysayers were coming out saying, or the doomsayers were coming out and saying, well, their attendance has dropped. And Disney came back and said, yeah, but they're spending a lot more money.
And that's okay. Yeah. So no, the US consumer looks to be in pretty good shape still. I haven't seen consumer confidence numbers for a little while, so that will be interesting to see how that goes as we progress. Meanwhile, in China, a couple of things happened during the week. The Chinese central bank cut interest rates, so their 1 year and 7 day rates, cut that by 0.1, which kind of caught everyone by surprise. No one was really expecting that. And the reason they did that is GDP numbers continue to decline and struggle, probably for obvious reasons, and that is their hard COVID zero stance. I mean, that clearly has a bit of an impact. We talked a few weeks ago around, while a relatively small number, there were a number of borrowers or property purchasers of property off the plan. I've got that all mixed up, but so they were holding back loan repayments, which, there's concern that might start spreading in terms of other people no longer paying loans or just not buying property off the plan. And like for most economies, property is a massive driver of GDP growth over in China, probably more so than most other countries. And so there was a few comments around Beijing's policies regarding interest rates might be too little, too late, and too inefficient. So there are some concerns, probably overblown. It's hard to tell whether this is external people looking in, trying to make assumptions, or internal people, trying to give an indication that things aren't great, but maybe being censored a little bit. But second half GDP growth will be interesting in China as to see what that looks like. And one other thing which I tacked in at the end just before, there was a survey by PwC of 700 US executives and board members across a whole bunch of industries, and over half of the respondents said they are terminating workers or planning to over the next 12 months, 6 months or 12 months. And 52% have implemented hiring freezes, and more than 4 in 10 are rescinding job offers, and a similar amount are reducing or eliminating sign-on bonuses that were common during. Now, if you're still doing sign-on bonuses, then yeah, I don't know. That seems to be the market. The market's still good if you're still paying sign-on bonuses. That's just my view. But I think this continues a trend and something that we talked about. The unemployment number is still strong over there. Weekly jobless claims they're not outrageous. I mean, they're not growing at a great rate, but they're starting to tick up a little bit. And my comment before about if companies are making a smaller margin, then maybe it's labour that they start to, at the margin, I wouldn't imagine it's wholesale recession-like unemployment, but, I think the Fed would be comfortable seeing that unemployment rate tick up a little bit, provide a bit of slack, and that reduces that wage inflation.
Yeah, I think PwC even came out to say if your company's not laying off people, the company next door probably is.
Yes. Yeah.
I think that's what they said.
And I think that's an interesting kind of insight into the market. It's no longer just the isolated, Bitcoin related or AI related. It's becoming a bit more wholesale.
Yeah, and I think we're just at the tip of the iceberg here, right? And whether this can be the soft landing that everyone's talking about, that we talked about last week, time will tell. But it appears as though there's no mass exodus. People aren't laying off people like in the flick of a switch. It seems to be. And I don't know why it is, whether it's just corporations and consumers having been cashed up over the last couple of years and having a lot more capacity to let things drag out a little bit longer. Maybe that's what it is. And we've talked about consumers never being in a better position to absorb and take a hit with the recession. And maybe that's what we're seeing play out.
Assuming they don't spend it all before we actually get into the recession.
Yeah, well, there's that, but prices are coming down.
But maybe the soft landing's possible. If all of this data starts to turn a little bit and the Fed ease off a little, maybe it's not out of the question. I'm still optimistic.
All right. I've got I've got one around the market rally. You know how much I love talking about this. Quote unquote, trust the thrust. So everyone's talking about this.
Hang on, what are we talking about?
We're talking about the thrust of the market.
Okay.
I'll get into it in a second. Just let me set this up, man. Everyone's talking about the dead cat bounce, right?
Yeah.
Like no one's believing this rally. No one believed the rally of 2020 when markets had shot up really quickly.
So for those who don't know what a dead cat bounce is, that aren't
Please,
familiar
you'll
with
do a
market
better job than I.
Oh, okay. So dead cat bounce is often referred to the market has fallen, it bounces, and then continues to fall.
Yes.
I don't know if a dead cat actually bounces, but it's a catchy little phrase.
Where does it even come from?
No idea. So often you'll hear this, the market's fallen and no one's believing it. You'll also hear it as the most hated rally or double dip recession. It's all the same sort of thing.
Oh, here you go. So for everyone, the definition is a temporary recovery in share prices after a substantial fall caused by speculators buying in order to cover their positions.
Oh, okay.
According to Google.
Right.
So where the phrase actually came from is the idea is that even a dead cat will bounce if it falls from a great height.
Right. Okay.
That's
Since there's substantial fall in markets, it bounces a little bit and then it's dead.
Yeah.
And then the market falls. Okay.
Yeah.
I'm glad we cleared that up.
Excellent. We'll add that to the glossary terms in the appendices of the doc. So everyone's talking about this dead cat bounce and no one's believing the rally. There's always a reason why the market can't continue the way it's going.
Yep.
And there's always reason why it's going to continue to fall even further. And we see that by analysts, reporters,
Even when times are good,
advisors.
there's a reason.
There's
There's always a
always
reason not to buy.
A reason.
Yep.
I think we did a chart, and I think lots of people have done it, but we made our own reasons to sell, and it's the stock market.
Oh, that's
and
right.
and
Yes.
it plots all of. I think we did one, the geopolitical one. We plotted.
Yes.
That's right. I went back in Wikipedia and had a look at every sort of major geopolitical event going back to 1900 or whatever it was, and we did.
Quiet night at the Baharian household that night.
It's what we do. No, that's when Julius was asking about, I was teaching him about, World War II and then SARS. And
Nice.
we were going deep into each of these things. It was fascinating. I learned a lot.
Yeah.
You should look into history and
Sure.
read. So the state of play right now is that markets are on track for a new bull market. And you can believe it or not, but if you're going to turn around and use these technical definitions as to why we're in a bear market, why we're in a correction, so 10%, fall of 10% is a correction, fall of greater than 20% or 20% and greater is a bear market. If you're going to use that terminology, you better use it on the other side when, is there a term for a 10% uplift? I don't think there is. But 20% is a bull market. So if you're going to use it on the downside, shove that in your pipe and smoke it because you better use it on the upside as well. So US stock market, NASDAQ's in a bull market. And the stats that's been being thrown around at the moment, and I'll get this up from Bespoke, a sentiment trader have put it out, is that 90% of stocks now, 90% of stocks are above their 50-day moving average. So a few weeks ago, we were talking about the moving average and why it's a technical indicator that people look at, but it is rearview mirror stuff, but it is somewhat informative. Having said that, and I'll get into the 200-day moving average now, I'll get this chart up now from Bespoke, and what Bespoke did is put together the performance of the S&P 500 after plus 90% of stocks rise above their 50-day moving averages.
Okay. Yep.
And this goes back to 1990. And so you can see the date on the far left-hand side, you've got the 50-day moving average, the percentage of stocks above the 50-day moving average, and then you've got the 200-day moving average as well. And you have a look at the per week, per month, 3 months, 6 months, and per year. And if you look towards the bottom of that, we've got 2022, so August. I keep getting mixed up. I think it was December. Bloody American date format.
What are you doing?
And so what you can see, I'll just throw some examples. So if you have a look at the one before that in 2021, the line item before that, 1 week later was up 1.79, up 2.55, 3 months later up 6.23, 6 months later up 6, 1 year later, up 9.37. But just focus on the far right-hand side. I think a year's not far away, but in this context, it is. The average gain has been a bit under 19% 1 year later. Mm-hmm. And the stock market has been positive almost 94% of the time.
Yeah.
So 15 out of the 16 times we've seen this over the last 32 years or so, you've got a more than 9 in 10 chance that the stock market is higher 1 year.
Yep.
And it's up almost 20% on average. The only time it wasn't was in 2010, where we had the massive rally up 15% 6 months in,
yep.
and then he had a decline of 3%. So Bespoke go on to say the current environment is also unique in that more than half of the index is still trading below its 200-day moving average, even though more than 90% of the stocks are back above their 50-day moving averages. Since 1990, only 3 other times we have seen this same scenario play out. April 2009, remember that was sort of the bottom of the market. Mm-hmm. October 11, I can't remember exactly what happened in October of 11, but then May of 2020, which was just after the bottom again.
Yeah.
And so
what happened in 11.
And so I feel like what's happening with just the 50-day moving average, obviously, because it's the last 50 days.
Yep.
But when you have a look at the last 200 days, obviously we haven't. The point they're trying to make is that there's still so much room to go for us to start even hitting above the 200-day moving average. And so these are all nice confirmation biases for me. Very bullish. But what's your take on all that?
94% of the time it's pretty consistent, right?
It's big, and the only time it hasn't happened was in, is that October or is that May? Whenever, in 2010. October of 2010. Just trying to remember what happened in October of 2010.
Was that when the Fed came out and said we're going to raise rates and we're just going to raise rates, and it fell from October through to December, and almost, I think it was like Christmas Eve, New Year's Eve or New Year's Day, the chairman at the time, which I think might have been Bernanke, came out and said, no, we're not going to raise rates, and the market then just rallied.
Yeah, I'm not sure.
I think that was it. But anyway.
There was a flash crash in 2010 on May the 6th. Did you know that?
No, I did not.
There was a fat finger moment. Do you remember that?
You get a few of those. They're pretty funny. I do laugh at those and feel sorry for the guy.
So what do you think about this? What do you think about?
Look, I think a lot of the market is driven by technical traders, algorithmic traders, and if it's an algorithm, then it's got to be based on certain rules. And 50-day moving averages, 200-day moving averages. I would imagine that there's programs out there looking for that as a buy signal and just pile in and buy, which potentially triggers other buy signals. So, it kind of makes sense. Technical, I've always kind of thought, is somewhat self-fulfilling. No offense to technical traders out there, but, I'm not overly surprised by it. I think probably what I'm more surprised is the consistency, of all of those instances. Only once has it not come true. I would have thought it'd be, often we see these stats at 75 to 80% tends to be the 1, 3, 5 year kind of number or average. This is fairly significantly.
Are you bullish?
Better than that. I was. I don't know, the rally, do you think? I don't know. I kind of feel like the market's just gone a little bit too far. Like we're just, there's probably a couple of reasons not to. No. I don't know. I think there'll be pullbacks, and I think I wouldn't be surprised to see a 10% pullback at some point, but I don't know that disrupts the current momentum and trend. And as you keep saying, and we've said, is the market is forward looking. So we're looking past, the market's already looking beyond this year, beyond the peak of rate rises. The question, and I think I said this last week, the thing that disrupts all of this is the Fed coming out going, no, we're still going hard. And that obviously changes everything. But in the absence of that, market's looking pretty attractive. There's some pretty good stocks out there. The index averages are back down around, PE averages are back down around historical normals. Interest rates are still relatively low. Consumers are still spending,
their balance sheet's
unemployment's
strong.
low. Balance sheet is strong. I'd love to see updated numbers on that. But, things are not bad.
Well, you asked, you hadn't seen August details for sentiment. Sentiment continues to click up. It bottomed out in July.
Yeah, okay. And I think we looked at that last week. We probably looked at it last week, so I have looked at it. But yeah, I mean, sentiment, that's right, because we were saying spending was up here and sentiment.
I'm sorry, it bottomed out in June. It was sitting at 50.
At
and
50,
July,
which was the lowest ever reading.
Yeah. I mean, I can. So wow, it is. So I've gone back to 1960. The sentiment is it's the lowest it's ever been read at.
Yeah. Oh, this is the Michigan consumer sentiment.
Yep.
Maybe we'll bring that chart up. But yeah, no, it's consumers are, if they start to feel good and inflation starts to trail off and interest rates start to pause, then, I mean, this could be a hell of a bull market.
Yeah. Anything else you want to talk about on this, or shall we move into director's cuts?
Let's move into director's cuts. Mate, what do you got? I was a bit lazy this week on director's cuts, so...
I've got a few.
You do?
So this is from Louis Vuitton.
The hell is this?
I'm going to bring this up now for everyone to see. Louis Vuitton have just... I'll read this from their website. The exclusive LV paint can is a widely creative alternative to a conventional bag. Styled like a real paint can, down to the metal handle, this cool collectible is decorated with playful references to Louis Vuitton's heritage. Roomy enough to hold 2 phones and other personal items, it comes in 6 eye-grabbing colours from the designer Virgil Abloh signature palette. Sorry, Virgil or Virgil. Mate, do you know how much this thing is?
Far out. No idea. I'm on their website.
Take a guess.
Far out. It's going to be expensive. $200?
Are you out of your mind? It's $1,800
Holy
US.
shit. Are you kidding me?
$1,895 US.
Wow.
For a
fucking
paint can.
Sorry, but...
Was it you that you were... I know what's happening. You know how the other day we were talking about like what rubbish you can put in your bins and not, and you're looking at paint cans?
No, you can't say this on air, man.
No. So what Louis Vuitton are doing, they're collecting paint cans from people at your house, putting
slapping their label on it,
shit on it,
and saying $1,800. Holy,
this is.
Cow.
I would.
I mean, that's absurd.
I don't want to be judging
right?
people, man, but like, who's going to be walking around with a paint can?
A, you look like a friggin' idiot. And B, everyone knows you spent $800
on a paint can.
You now no longer have any money to store in your paint cans. You just spent it all. On your
this is the
paint
market
can.
top. Didn't we call the market top on the that $2,000 umbrella?
Hell,
remember the umbrella that didn't work in rain?
It wasn't for winter. It wasn't for rain. It was for the sun or something.
It was aesthetic. It was just like for looks. That was the peak of the market. Hey, maybe you're right. Maybe Louis Vuitton are coming out with this thing at an absolute ludicrous time in the market where people are still spending money. They're just like, this is the last squeeze.
Gasp,
let's just do it.
How can we fleece these suckers one more time? Boom, paint can. Like, who's sitting in a room going,
I don't know,
all right,
man.
Who's got ideas? I got one, paint can. They're like, that's brilliant. Let's do it. Like, who is doing this? I don't know.
Wow.
Maybe I'm just too old.
Do you know what I reckon could have also happened is with the price of like all this building going on, they've got all these like material left over. Like, what do we do with it?
Yeah. Man, the profit margin would be huge then. I mean, it's going to be huge anyway, right?
Here's another.
What do you got? What else you got?
Funny one. I came across in my readings. Japan is bidding to get young people to drink more alcohol. Do you know how they're doing that?
I don't know why they need to try it. Surely that should be just happening.
So
come on,
the
Japan.
tax agency, who is it?
So the ATO equivalent.
Yeah. So basically, this is basically what's happening. The ATO have come out in Japan, so the National Tax Agency, with a slogan. It's called Sake Viva. Right? Okay. And what they're doing is imagine the tax office came out and said, we're running competitions to try and encourage more alcohol drinking because our revenue on alcohol is down. That's what's happening. So in Japan, the National Tax Agency have come out with a campaign to revitalise, quote unquote, the nation's liquor industry. Wow. And it was launched in July. So they're running all these competitions to do with beer and alcohol.
What do you win?
I don't know what you win. I haven't...
Reduction in your PAYG tax?
So the whole The whole
Imagine
point of
that.
it is to try and encourage people to start drinking more. And it's targeted at people aged between 20 and 39. Those people that are probably quite vulnerable just in life in general. And let's just get them to drink more alcohol.
Man, they're targeting the wrong market. If you got kids, which I'm assuming is in your 30s, then you're not drinking more.
Right.
Man, that hangover hurts. Kids wake up in the morning. Dad. Anyway,
I know.
That's crazy. That's awesome though. Come on, ATO, step up your game. What are you doing?
Can you imagine? So they've been
People be losing
hit with
their
quite a
mind.
bit of backlash on social media.
I imagine they are. Yeah.
They're copying it pretty hard now, but so was that one. The other one, on a more serious note, which I thought was fascinating. So this is I only came across this last week, but it was published on media earlier on the year, and I don't know why it only sort of came through my feed recently, but there's a company, I don't know who the company is now. It's called the Gemini battery, and it ranges 1,200 kilometers.
Whoa.
And so I think there's two batteries. The first one gets you to the first 250 kilometers.
Yep.
The next one kicks in for like 1,000 kilometers on a full charge.
Wow.
And so BMW,
Full charge, full power. Like there's no.
yeah, that's it.
Whatever.
I'd say it's probably like highway driving, right?
Still.
1,200 kilometers, and it's double,
Man, that's huge.
almost triple that of the Tesla.
That's pretty good.
So the Tesla Y performance model does 550.
Yep.
It's not quite triple, actually. It's a lie. It's more than double what the battery
Straight out
does.
lie. But still 500 is pretty good.
Yeah, but this is double.
It's
It's
big machine,
1,200
but-
kilometers. And
That's
so
crazy.
Gemini is going into the BMW X3, I believe, next year.
Okay.
And so that's going to be powering
Wow.
BMW's
That's huge.
EVs.
And that's huge because for so long people have been saying Tesla have such an advantage because of their battery tech.
Yep.
And that's really interesting.
That's why I found this really fascinating. So it's coming out of Michigan. So it's been dubbed Gemini. I don't know who the company is, though.
I wonder if you could replace your Tesla batteries with this Gemini battery. Like if you have a Tesla.
I don't know. So what they tested this on a Tesla. So they put the Gemini battery in
Yeah,
a
I
Tesla.
saw that, which is kind of...
And so it did a road trip up, what's the Mitten of Michigan and back, traveling on highways and averaging a speed of 55 miles. Oh, well, that's a jib.
55 miles?
Yeah, you're going 100 Ks an hour, more or less.
Yeah. Well, how fast do you drive?
No, but I'm saying if you're stop starting,
Oh, yeah.
I think that could be different. But
But I think still that 500 odd Ks, that Tesla, that's highway driving too, isn't
you're
it?
probably right, actually. That just came to mind now as well. That's probably right. So that's interesting. It just shows, to your point, the evolution, how quickly some of these things can turn.
Yep.
Who was I talking to? Someone that I know was in New York, and Audi were presenting at something and talking about their technology they've been developing over the last 10 or 15 years, and a lot of the technology they can't release. And I think Tesla's the one pushing the boundaries because of human beings and their ability to be able to implement automated AI in vehicles. So, for example, Tesla's autonomous driving. I don't know if you've seen some of the videos of the test. You know, Tesla keeps running over kids; it doesn't stop. And they're tested against other cars. They're autonomous driving and they're stopping. So there's still a lot of that going on. There's a lot of advanced technology, and I think once it can be released, it's going to happen a lot quickly. It feels like it's just quite exponential.
Yeah, it is. Why can't Audi release it? Is it just not ready to be
No,
released?
I think it has to do with laws and
Yep.
just that, with Tesla, how AI makes decision whether should I go left and kill that, young kid, or do I go straight and hit this car and kill a car of 4 people? And so I think they're the issues that autonomous driving is facing.
Yep.
And I don't know how you resolve that.
No, I don't know either.
Anyway.
So I've got one thing, Bed Bath & Beyond. So I mentioned this last week.
Oh, yeah, we're talking last week.
The Reddit Wall Street Bets guys were back on board the meme stock train, buying Bed Bath & Beyond. And it was up 60-odd% last week, or maybe even slightly more. All on, well, maybe not all on, but from the posts I read, on the premise that there was a shareholder, someone had gone in there and bought a large portion quite a while ago. He was still holding. That shareholder is Ryan Cohen, who's an activist shareholder. Anyway, so over the last week, let me just get the numbers here. So the Wall Street Bets, well, the traders have bought $171.4 million worth of stocks and options in Bed Bath & Beyond over the past week. Mm-hmm. And 73 million on Tuesday, which was an all-time high for value of stock purchased on that particular day. Did you just do something?
Yeah, I just moved some things myself.
And so that was all good. So the premise was this guy bought in 5 months ago and he's still holding. Well, how things can change. So overnight or yesterday in the US, Cohen
dumped his stock.
Basically the SEC confirmed that Cohen has basically sold all of his stock, every single share. And so the shares were down 20% during trading, during Thursday's regular session, and a further 44% in after hours trading. So I just thought it was fascinating, kind of made me smile a little bit.
Why, man? Why do you want to see this happen?
No, I just, this buy because someone else is buying and this guy said it's going to go up to, on some of the posts like, this stock's going to $45 by next week, so get in. And so people just buy.
Yeah, it's funny. You look at the Bed Bath table 5-day chart before the peak. It's literally, if you could cut the peak and the last, so if you just do a 5-day chart, it's back to where it was at the rate it was growing before all of these, before all this happened.
Yep, it's right back.
It's like nothing ever happened.
Oh no, hang on. So after hours, you can see that it's dropped 44% down to $8.28. So the start of that chart's at $11.
Yeah, okay.
So we're back down.
Oh yes,
to where we were.
Yeah, good.
Not that long ago though. But if you have a look at a 1 year chart, maybe we'll bring this up. Check that out. Check out the 1 year.
Yeah, right.
I mean, that's mental. So that's what happened over the last couple of weeks. You can see that spike, and it's going to drop all the way back to maybe or basically give it all up.
Maybe a dead cat bounce.
It's just a dead cat, man. There's no bounce.
All right, what do you got for tips and recommendations for us today?
Maybe you go first because I.
All right. Well, yesterday we had a meeting. And with a few people, and we kicked off.
Ah, that's right.
We kicked off at our office just with a couple of drinks.
I was not involved. Just to be clear.
And went to Maha for dinner. I think I've mentioned Maha on the podcast before, but man, the food was bloody good.
So I don't know anything about Maha. So
all right,
educate me, mate.
So Shane Delia, is he Lebanese?
Never heard of him.
He's so he's like a celebrity chef. How do you not know? How do you not know Shane?
I'm not cultured.
So he runs like he's got other restaurants. What else does he have? Does he still have Biggie Smalls, a kebab joint? It's like a.
Oh yeah, I've heard of that.
Yeah, so he runs Biggie Smalls, Maha. I don't know what else he does. What other restaurants he has? Oh, here you go. Delia Group Restaurants, Maha East, Maha Bar, Biggie Smalls, and Middle Ground. That's right. He was a founder of Providor, the food delivery company. So anyway, that's his restaurant, and it's on Bond Street, just down the block from our office, down Flinders Lane.
All right.
Turn left onto Bond Street. It's on your right hand side.
Yep.
It's bloody expensive though, I must say. But the restaurant last night was full. Thursday night, packed.
Really?
Full.
Right.
And yeah, it's not cheap, but the food is bloody good. It's kind of a special occasion place, I reckon.
Yeah.
To go.
Yep.
But yeah, look, the food. We had a five course dinner.
Jeez. Living it up, mate.
I don't think I was paying.
There you go. Even better.
Maybe indirectly. But no, it was good. The food was great. It was fresh. The menu seems to have changed again. And because I'm vegan, I get my own special little dishes as well. So everyone kind of gets, I don't know, like the beef, and then I'll get this, I don't know, like a mushroom dish or a falafel with, I don't know, some pomegranate, some juice. It was just bloody good.
Nice.
If you want to go for a special occasion, head down to Maha. 3 courses. I don't think
Do you have to book in
100%.
Oh,
You have to book.
All right.
I don't think
Not
I'd
just rolling up.
No.
All right.
I wouldn't be full on a 3 course. The 5 course is bloody good. So that's my tip for today.
Nice.
Try and get there before we hit the recession and we've got no money to spend.
Yes. The recession that we may or may not be in, that may or may not be coming.
What do you got?
All right. So a couple of weeks ago, it was a nice weekend. We went out, just kind of decided we wanted to get out into nature. Just
Nice.
to do something.
You didn't go to Redwood Forest, did you?
No, mate. Well, it was that same weekend.
Oh, okay.
So we went to a place that I'd never heard of before called the Organ Pipes National Park, which is just off the Calder Freeway, just on the outskirts of Melbourne. Now,
What is it called?
Organ Pipes National Park.
Ah, cool. Keilor.
Yeah, it's...
Oh,
is that
wow.
where it is? Anyway, so this rock formation... Anyway, so I guess what I was going to say is just getting out was really enjoyable. It was a beautiful sunny day. Just had a lot of fun, just, whatever, messing around, throwing rocks in the river, doing all that sort of stuff. Kids had a great time. But this Organ Pipe, so I don't know if anyone's ever seen it, but you can quickly Google it. Essentially, this rock formation or this formation has been, these rocks have been formed over millions of years. And I think it's 3 to 5 million years, they think. And essentially, it came about because a volcano exploded, lava's kind of formed down, and as the top lava has cooled and the bottom layer, the top layer is cooled and the bottom layer is still hot, so it's worn away these rocks. Anyway, it's created this Organ Pipes formation on the side of this mountain or hill or whatever it is. But it's pretty awesome.
How long did it take you to get there?
20 minutes.
Oh, okay.
Not long. I mean, it's just on the outskirts of Melbourne.
Can you do picnics and stuff there? Or
yeah, mate. So they've got a bunch of tables, chairs at the top. So you kind of drive in, you're up here, and you have to walk down. And it's a fairly steep,
Oh, okay.
path down, and coming back up is bloody steep. But it's pretty cool. Pretty cool setup. There's toilet
How'd you find out about it?
And we just Googled. We just went, all right, where's a park outside of the city that's not too far away, but somewhere we can spend half a day getting to cruise around there and back. And it was just fun. So I guess my recommendation is just get out. If, like it is today, sunny over the weekend, get out and enjoy the parks.
But even in winter, like cold days, just so nice. Puff jacket up, beanie on.
Sun's got to be out though. Raining and windy. No, I'm having none of it.
Raining and windy.
But it's pretty cool. So that was my recommendation. Get out and enjoy what Melbourne, Victoria has to offer.
Before the footy finals kick in and everything's shambles. Looking forward to seeing the Pies play the Blues this weekend for the final game before the finals.
Oh, is it the finals that close?
Yeah, finals next week.
Thank goodness. Thank God this season's almost done.
All right, thanks for tuning in.
Cheers,
and
guys.
We'll catch you next week.
Right.
See ya.
See ya.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.